Hello, everybody. Welcome to the first episode of Valuation Nation. This is the podcast where we break down companies strictly through the numbers. There's going to be some qualitative analysis, and I'll be asking questions that point to quality over quantity. But Steven over here is our expert at evaluating companies, really understanding them, explaining them very deeply. He's an author for Seeking Alpha as well. And he has had many years of hidden spreadsheets that he really had no use for other than his own personal gain to figure out how he should value companies. And we came up with this idea a couple weeks ago where we said, look, what if we just put these documents out into the world and we actually analyze them through the numbers, meaning the real numbers, not just market cap, but looking at things like price to free cash flow and forward earnings and PEG ratios. And what if we make a podcast out of that? So fair warning for all of those that are watching or listening to this. This is not going to be a podcast that is super exciting to listen to. We're not going to be covering all the day-to-day news and exciting stuff. This is going to be a boring podcast where we go through the numbers and the numbers only. Again, there will be some qualitative analysis, but mainly numbers. And we're going to try to ask ourselves a question at the end of every episode of this podcast, which is this company overvalued or undervalued? It's not financial advice. Do not make your decisions based on listening to this. This is our interpretation based upon some numbers and qualitative analysis of how can we come to a conclusion of, in this market during this time, is a company undervalued and overvalued. And every episode will hyper focus on one company. So you'll get an hour 30 minutes of our time dedicated to one company. Steven, before we get into it, first of all, I just want to introduce you. Thank you for being here. And are you excited to start this podcast with me?
Yeah, I just really hope this doesn't get taken out of context.
So the reason Steven's saying that is because we're going to get into the introduction of our first episode today, which is Tesla. Now, Tesla's a very hot topic. Tesla is down 60% on the year. Steven, if you go to his Seeking Alpha articles, he has honestly been predicting some of this decline. He historically has not been very high off the valuation of Tesla. He has been saying that the company's a bit overvalued, and he's had a lot of logical analysis and reasoning to strengthen his argument. And this year, 2022, we've seen a lot of his conviction or a lot of his analysis kind of play out. So this will be a bit of a controversial episode if you're a super hyper bull. If you're a delusional bull, I think it'll be complicated for you to get through this. If you're not a delusional bull, if you're someone who cares about numbers, if you're someone who's not just obsessed about robo-taxis taking over the world, I think you will enjoy this podcast because we are actually going to break down the numbers around Tesla and argue for its valuation and what it is in today's day and age. So one request we do have is please don't take things out of context. Don't misquote Steven. Don't just take little clips of this and put this on the internet. This is one of those podcasts that's actually meant to be consumed for an hour. And if you don't have the time for that, that's okay. But this is one of those things where you're supposed to consume it for a while to really get a grasp of that. Otherwise, the podcast is not going to offer too much value.
And I want to add one thing to what you said. Everything I took is actual numbers. I'm not making anything up. And this is my interpretation of how I look at the data, from the balance sheets to the income statements, to the cash flow statements, to auto sales. These are, once again, not my numbers. These are the actual real numbers and how I interpret data. And please do not take what I say out of context. This is just my opinion of how I look at things.
Okay, here we go.
Before we start, Amit, are you a shareholder of Tesla?
I am a shareholder of Tesla. I have about 10 shares at a 220 average. My long-term conviction in Tesla is pretty high, and I don't want to bet against Elon Musk, but I'm not delusional, and I like knowing about the numbers, and I like understanding more about the numbers, and that's why I think this podcast will be exciting.
Okay, so I am also a shareholder of Tesla. My wife purchased shares. I did not purchase shares. My wife did, which makes me a shareholder of Tesla. And Tesla is a large component of S&P. And indirectly, I have Tesla in a lot of funds. So when Tesla goes down, I lose money. I do not have a short position. I have never had a short position. And it's not a company I would ever short, nor I've never shorted a company in my life. So I don't want to see, even though I'm probably going to see it, oh, Steve has a short position, blah, 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 blah. I don't. And I am a shareholder. So I just want to get that out of the way.
Yeah, and one thing I do want to say about Steve is he's someone who really started developing a name for himself, at least in my small community on my channel, because he broke down Palantir's numbers. And, as much as we talk about Palantir, a lot of people don't actually break down the numbers. So Steve, really, I respect him a lot for the numbers and models he builds on his own time. He doesn't do it for money, right? He literally just does it to come to his own conclusions. And that's why we thought this podcast would be pretty exciting. So throughout the podcast, if you have any comments, please leave them in the chat and we'll put some of them up. But I guess we're just asking to try to remain a little bit objective here and listen to the argument and make your conclusions after that.
Yeah, and if we have time, we'll try to, I guess, do a Q&A afterwards if there's a bunch of questions.
There we go. All right. Here's the presentation. Time to answer if Tesla is overvalued.
All right, bear with me one moment. Okay, it's changing. So before we get started, I wouldn't bet against Elon Musk. This guy has a relentless work ethic that has accomplished more than pretty much anybody else in history. And I don't believe anybody else could have done what he did with Tesla. This is a guy who slept and breathed this vision. He went into battle with Ford, GM, and all these other auto companies and completely changed the industry from a combustible engine in the ICE world to EVs. And what he has done and what he has accomplished is absolutely amazing. One of the things I really have disliked seeing news headlines and other things with people blaming Elon Musk for Tesla's decline. You don't blame Jordan for missing a shot or the Bulls for losing the game. Jordan is clutch. He got you there. He deserves the credit. And if he misses a shot, you don't bash him. And I think people are really incorrect with bashing Elon. Look, the guy made his money fair and square. He has other things he's interested in. He's always been that way. So him purchasing Twitter and doing whatever he's doing is not out of the ordinary for this guy. Everybody knew what they signed up for. He's had other companies the whole time. So I just think it's a little unfair that people have been bashing Elon. But, you look at Tesla, this is a phenomenal company. And one of the things I always separate is the company and the stock. Tesla is a phenomenal company. It's a company that's revenues gone up by 74.45 billion in the past decade. Absolutely unbelievable growth. Out of this world. So I always separate those things. And before we actually start getting into it, as Amit said, I have said this, and
little bit of a psychic this year, huh?
Look, I get a lot of things wrong. Let's be very clear. I get a lot of things wrong. Down on Palantir, down on SoFi. You can't predict everything. But with Tesla, I am not just coming out of the woodwork saying it's overvalued or that it doesn't make sense. I'll give you my prediction at the very end. But previously, on February 15th, I wrote an article that Tesla could go down by another 30%. It's down by almost 60% since then. In May 6th, wrote another article. Tesla was overvalued by over 85%. It's fallen 58% since then. So take it for what it's worth. All right. So I looked at two bull cases and I try to really consume as much information on stocks as I can. So ARK Invest is arguably Tesla's biggest bull behind Elon Musk and then Ron Barron. So ARK Invest's expected value pre-split was $4,600 a share. And I believe it was a 5.3 trillion market cap in 2026. Ron Barron is saying $500 to $600 per share in 2025, 4.5 trillion market cap in 8 to 10 years. So those are the bull cases that I have in my mind. And I read through ARK's report and it's interesting. So just want to throw this slide up. This is Tesla's Q3 2022 statement of operations. I take all my numbers from credible sources. So ARK Invest has some interesting outcomes. So in their bear case, they're saying that Tesla is going to sell 10 million cars in 2026 and 17 million cars in their bull case. and that the average unit price is going to be 38,000 per unit on the bear case and 30,000 even on the bull case.
Yep.
And the chart on the right is ARK's revenue, EBITDA, and market cap projections for, I'm going to speculate, the end of 2026. Give them a little bit more time because they didn't actually say, and if they did, I missed it in the report. So they're saying Tesla is going to generate 843 billion of revenue, 280 billion of EBITDA, and have a 5.3 trillion market cap. And electric vehicles is going to be 57% of their revenue. Would you agree it's on the screen? These are not my numbers.
These are not your numbers. These are
Okay.
from Miss Kathy Wood herself.
I don't know who actually made these numbers, so I'm just going to say ARK Invest.
Tasha is the main lead on the ARC team, so she'd probably be responsible for this.
All right. So what do we have here? First quadrant on the upper left, you have Tesla's current market cap is 385 billion and change.
That is correct.
To reach ARK's base case, this is what they expect, it's going to have to increase by $4.9 trillion, which is almost 1,400% in the next 4 years.
So compounded annually over 4 years, that's more than 300%. But 300%, more than about 350 a year. Yeah.
So as we saw in the chart at the bottom with the 3 pie charts, they're saying Tesla's revenue is going to be 843 billion. I can't quantify if they're going to get that 34%, which would be 286 billion from robotaxis, human drive ride haul. I can't project that. I mean,
wait, 2026, they say 840 billion in revenue?
843 billion in revenue.
In 2026.
2026.
Okay. Interesting.
So
right now they're doing 100 billion in revenue, right? 21 billion a quarter.
74
okay.
In the trailing 12, I think 74, 76. So they're saying 57% on electric vehicles. That means that electric vehicles alone is going to generate $480 billion of revenue. And that's going to be 57% of their overall. Right now in Q3, it was 87% and change. It did 18.69 billion out of a combined 21.45 billion in the quarter. So it has a long ways to go. So when I reverse engineered ARK's expected value case, so that was the numbers from the pie chart, 843 billion total revenue, 57% EV, 480 billion revenue. So they gave a 30,000 average price for the bull case and a 38,000 average price for the bear case for the price per unit. So I split the difference. This is one of the very few numbers that is my number because I did not see a unit price on the expected case in there. So I figured if you have the bear at 30, the bull at 30 and the bear at 38, split the difference on the expected. To me, that makes sense.
Right.
So they're going to have to sell at 34,000 per unit, 14.13 million electric vehicles to generate that $480 billion in revenue from electric vehicles in
1 year in 2026, right?
Yes.
Okay. Got it.
And I'm not going to reverse engineer robo-taxis. We can talk about that a little bit later, but there's no data. I have no idea what the laws are going to be from the government. I'm not going to make projections on that. So the U.S. auto market, I would argue, is Tesla's biggest market currently for sales. They have just under 4% of the total market. And in the first 9 months of 2022, they have sold 396,000 vehicles.
In the past 3 quarters of 2022.
Past 3 quarters.
Okay, 396,000. And the Q4, what they're estimating another 100,000, something like that.
I don't remember.
But it
So
wouldn't get us to 1 million for the year, no matter what they do. Yeah.
I would doubt it. So you look at worldwide car sales because they are operating or they will be operating in other countries. 2021 worldwide car sales was just over 58 million cars.
Mm.
All right. So in the bear case, selling 10 million cars, they would capture just over 17% of the worldwide global automobile market. In their expected case, which they are saying is their baseline, they're saying Tesla is going to have 24.29% of the global auto market based on 2021 numbers. Obviously, I have no idea what the global auto market's going to do, so I'm taking the last full year numbers that we have.
Yeah, well, you can make a reasonable assumption that in 2026, even if the global market goes up, which there can be a bunch of
65
variables,
maybe, 70, I
right?
don't.
And there's a lot of variables that says it doesn't go up. I mean, what if Uber comes out with some where people just take more? I mean, there's so many random things that we're not thinking about, right? Another
Too many
pandemic could happen
variables.
for all we know, right? Yeah.
Yeah, I mean, look, and that's the great thing about investing. At some level, you got to make some projections that are guesses
Yep.
to fill in the void. And on the bull case, they're saying that 29.22% of the 2021 global market. I mean, trying not to laugh, but these numbers are high, in my opinion. I mean, I look at if I just go back and look at just the US auto market, General Motors has the largest segment at 16%. I mean,
Right.
look, can Tesla get there? Sure, anything's possible, but I look at things and try to think if they're probable or not. In case the ARC is laying out on the EVs, I'm not saying it can't happen, but I just don't think it's probable when I look at how many cars Tesla has to increase their sales by. So before we get to the valuation numbers, what do you think about the car market and Tesla from what I
This doesn't
showed?
make any sense. 14 million, 24% in an expected case value case of total. This does not make sense. I find it very hard to believe that a company could sell 24% of all the cars because that would have to be outside of the US, which means they have to capture markets in China. And my limited knowledge of cars, but somewhat personal experience tells me that India is a pretty big market.
Well, I have it
And
right here. You're right. India, big market. Europe, China, US.
yeah, it seems like that growth would have to come from China and India. I mean, Europe and US are not going to get you 24%. And in India, I mean, from just like pure naivete, when I've been to India, you know, forget electric cars or robo cars. I mean, they have cows still walking on the or whatever they're doing on the street, right? Like to introduce Teslas in that area, which is a sophisticated electric vehicle in a country that has not even developed its own electric grid yet. I mean, it would be hard to see that. And then in China, from what I know, is BYD is catch. And again, we can get into competition, but it just seems like on first raw emotion that it's hard for them to get at least 17% of the global auto
Yeah.
market.
Well, let's speak about competition for a moment. You're telling me that Mercedes, BMW, Honda, Toyota, Ford, GM, you're telling me Volkswagen, you're telling me they're going to take this line down. They're not.
Yeah.
And I'm not saying Tesla's not a great product. People seem to love them. I just think the competition's coming. And I think Tesla has definitely a head start, but we don't know what the variables are going to be when these other companies start coming in. So I think it's going to be very hard to get to that cars sold to meet that expected revenue. And the reason I'm not going to speculate on robotaxi or anything else, there's too much unknown. I mean, would you, unless you were doing it strictly for a business, would you actually purchase a Tesla and then when you are not using it, enter it into a robotaxi program?
it's a bit hard to imagine myself doing that. Now, granted, 5 years from now, it might become the norm, just like it was hard to imagine you rent out your house to strangers and Airbnb happen, right? So it's possible, but it's hard to imagine doing that per se. Now, if the car is making good money for me, maybe, but the convenience of not having my car would kind of suck. One thing that I do want to make a point about is this was Elon's goal, right? His entire goal was to create a framework that forced every other auto manufacturer to transition to electric. And this was part of the master plan because that would create the sustainability of the advance of sustainability for electric vehicles and fighting off climate change. And in that process, he said there would be massive capital appreciation. The company's gone from 10 billion to 395 billion. He has massively appreciated the share value of this master plan, but it does make sense that if you wanted Toyota and BMW and Honda to make low-cost electric vehicles so that we could stop burning the planet, then you want to welcome competition. And I mean, whether you welcome it or not, it's coming. The question becomes, can you maintain the monopoly you had to go from 0 to $1 trillion at one point in the next 5 years? And I guess just on raw gut feelings, it seems like as good as the Tesla car is, that's not as likely to maintain that monopoly.
And I think the problem I have with the whole robotaxi thing is I think more people, if the numbers made sense, would buy Teslas and enter them into the program as a business opportunity.
Yes.
If the numbers made sense. If there was not a positive return to do that, I think you'd get a mixture of some people that would enter it into the program when they're not using it at night. And I think there's some people that would think I'm absolutely not doing that. I think it would be hit or miss.
Right.
And until we get some data, there's no way to project what that's going to generate because you can't make assumptions that everybody that has a Tesla or 75% of people that have a Tesla will enter it into a robotaxi program unless there was a questionnaire that every Tesla purchaser filled out, and that was a question, and you can quantify it. I haven't seen that data, so I can't make a projection on that. So it's very hard for me to take any of those numbers, and put them into anything that would make sense on a projection level.
And also FSD has to work, right? Like if FSD doesn't work, there is no robotaxi.
There's going to be government regulation. We don't know what the laws are. I mean, it's just, we're talking about 4 years. 2026 it's going to be 2023 next week.
Yeah.
Nobody knows what it's going to be. So that I can't do it. I can't make a projection on that. All right. Get into the fun stuff. Ready?
Yep. Valuation.
Got a question for you. Would you rather company A or company B?
All right. So company A has a $385 billion market cap, 74 billion in revenue, 16 billion in cash, 7 billion in capex, 8 billion in free cash flow, 5.1 price to sales, 43 price to free cash flow. Company B, 384 billion market cap, 1 trillion in revenue, 149 billion cash from operations, 63 billion cash capex, 86 billion free cash flow, price to sales 0.33, price to free cash flow 4. I would want,
if you could buy, and now let me frame it a different way because this is not really a fair question. It's more of a trick question. Okay.
Yeah, I see.
I would just say to you, if you could buy one of these companies outright, which one would you buy?
Company B.
All day, every day, correct?
All day, every day, because it has $1 trillion in revenue and its market cap is less than its revenue.
And its free cash flow is over $86 billion. And now when I say it's a trick question, company B is not a real company. It's a combination of companies. Combination of Ford, GM, Volkswagen, Mercedes-Benz, BMW, Honda, Stellantis, and Nissan. So Tesla has a bigger market cap than these companies combined. Still, after falling, what was Tesla at its peak? 1.1, 1.2 trillion?
1.2, yep.
So it's fell to just under 400 billion, and it still has a larger market cap than all of these companies combined.
Why do you think is the reason for that, Steve? Like, what's the premium investors are giving it from a qualitative perspective? Because obviously the numbers, I mean, the growth rate, 50% year-over-year growth. That's none of these companies are doing that, right? Ford and GM.
Look, this is a personal opinion that I'm about to give. It's a speculation. It is not fact. My own personal opinion. I'll be very clear. People are valuing, I think investors are valuing Tesla as a big tech company with explosive growth. Tesla has explosive growth. Let's be very clear. Company's phenomenal. And I think that people have just looked past the raw data that the majority of its revenue and profits come from automobiles. Because people look at it as an energy company, which, if I was to go back to other slides, ARK Invest doesn't even put energy in their 2026 case, which I thought was interesting. And they look at it from a robotaxi standpoint, they look at it from a ride hail, they look at it as what Tesla has accomplished is amazing. Give them another 4 or 6 years and look at what they can do. And Tesla's earned that right to a degree because they changed the auto industry. So anybody betting that from an operational level that Tesla can't change other things or just bring other things to market and change how lives are lived with driving, I wouldn't bet against that. But coming to a valuation that is palatable for me to invest in is a different story. And that's how I would answer that question.
But again, the growth rate that is exploding, and let's say it continues, that still does justify a premium. If
To
they
a
can do
degree.
50%.
To a degree.
Right. You disagree with the premium still, even though the growth has been 50% year over year.
Let's get through some more of the slides.
Okay.
So this is just the supplemental information. Once again, not my numbers. You can go through the cash flow statements and the income statements, and this is what it is.
So GM and Tesla have the same price to free
Price
cash
to
flow
free cash flow,
relatively.
yeah.
Interesting. Okay. Got it.
All right. So I put a slide in for everybody, just the importance of free cash flow. So I personally like it because it's hard to manipulate this number, and net income, which is profitability on the income statement, because of GAAP accounting rules. Sometimes factors come into play that can possibly distort that number to a degree. If you look at Cheniere Energy, I was really researching them. I went through the 10K because of their LNG exporting. GAAP accounting doesn't really do justice for them on a net income level because it has them losing a tremendous amount of money. But the way that their business is, they have to take a markdown in some fashion because of what they buy the natural gas for, from what they sell it. I'm not an accountant, so take it with a grain of salt. But you look at their free cash flow, it's a much different number. And to me, it's a better measure of profitability because it's just hard to distort. So I like using free cash flow. And this is cash minus CapEx.
You taught me about this metric more than anyone has ever taught me about a metric. And all the reasons you have on here have started to make this my favorite metric as well, just because it can't be manipulated, as you said.
Yeah, I mean, you don't know what the accounting rules are with taxes or write-downs or drawdowns or anything. So this is just very easy way to look at profitability and look how much cash companies producing. This is where buybacks, this is where you pay down debt from, this is where the dividends come from, this is where you make acquisitions from. So this is what I like to look at. I look at everything, but I give a little bit more prestige to this number. Let's look at Apple. So, my opinion, Apple is the best company in the market. My opinion only. It's the most profitable company in the market. Apple does not report on a calendar year. Their Q4 is everybody else's Q3 that reports on a calendar year. So they just finished their fiscal year of 2022. They generated $99.8 billion of net income and $111.44 billion of free cash flow in 12 months. I have not seen another company that's ever done this. I actually think, if memory serves me correctly, Berkshire may have come close on some of these numbers one year. I don't remember. but I have never seen a company generate these types of numbers. So a lot of times I look at things and I say, well, if Apple's not getting that valuation, why should other companies get a better multiple than Apple when Apple, at the end of the day, businesses are set up to generate profits.
Yep.
That's what they're set up to do. Apple is the most profitable company in the world. And I get it. People think I don't understand growth. Well, okay, maybe I don't, but Apple's revenue over the past 5 years has grown by 72%, $165 billion. It's a lot harder to go from 150 to 300 billion than 1 to 2 billion. A lot harder.
Yep.
I mean, their net income's grown by over 50 billion, and their free cash flow has grown by almost 60 billion in the past 5 years. So you can't say to me that Apple doesn't have fantastic growth as well. From a percentage basis, it may not be as enticing as Tesla's, but from a raw number, it's phenomenal.
I would agree, and it seems like Apple. It seems like you're coming to an argument that if Apple's not getting, well, yeah, here we go.
So I reverse engineered Apple's market cap, and when I looked, it was 6.5% of the S&P and almost 13% of the NASDAQ 100, based on SPY and QQQ. So, okay, there's a lot of ways you can look to value companies. Some people like price to sales, some people like price to free cash flow, some people like PEG, some people like PE. I mean, there's a lot of different ways to value a company. So I started looking at all these things and I came up with my own valuation methodology. And I said, okay, I'm going to reverse engineer Apple's market cap. I'm going to create a methodology out of that. And I'm going to judge companies by that. Because for me, once again, my numbers, my view, if Apple is my yardstick, I'm going to go based off of Apple, up or down. So my opinion is you can't just go by the profits, whether it's net income or free cash flow, because you still have equity on the books. Company goes under after all the liabilities are paid from all the assets being sold. Theoretically, the total equity on the balance sheet is going to the shareholders.
Yep.
Theoretically. So you have to give some type of value to the equity on the books. So what I came up with is, okay, what if I minus the equity from the market cap, and then what's left over, do a multiple on free cash flow? For me, that makes sense. I redid these numbers the other day because how much the market dropped. And so now if you do 18.37x free cash flow plus total equity, you get within $17 of Apple's market cap. So that's how I am going to value companies for right now.
Right.
And I have said for a long time, for growth companies, I don't mind paying a little bit of a premium. But when you start talking about value investing, which a lot of people do, there's a lot of numbers that come around. And I think that it's a range depending on a lot of different things. And I think, 17 to 23, 16 to 24x free cash flow is a good level. People can disagree with Paul from Everything Money as much as they want, but guy's super smart. And he goes by 20x free cash flow on a 5-year average. That's great too.
Real quick, the valuation you did just now led to a discrepancy of $17 within the current market cap and the market cap you have, correct?
Correct.
And can you just walk through repeat again exactly what you did to get to that valuation?
Yeah, so I took Apple's market cap, I minus the total equity from the balance sheet.
Right.
And then I divided that number by Apple's free cash flow.
Interesting.
And it came to 18.3678893 blah, 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 blah. So I got it within $17 because I didn't feel like continuing to write everything out.
So this valuation metric that or the methodology is not that far off, one could
I
argue.
mean, I would like to see another methodology that gets as close as I just did, to be honest with you.
Okay.
I mean, you can divide it by earnings from operations and put a multiple on that, but you're never going to get $0. Maybe you can come within $20 or $17 again that way. If you want to use a multiple on earnings from operations, that would be fine too. I like free cash flow. And I'm not saying this is the only way to value companies. It's what I like to use. That's all.
Okay.
And I think if you find a valuation method, you got to treat all the companies equally when you start looking at things. So that's what I did. And I looked at 38 different companies because I'm crazy. I wonder if I don't know if I can make this bigger or not. Give me a sec.
You can probably.
Oh,
There you go. Perfect. Yeah, you got it.
Come on.
You can move it to the right and then move it to the left when you want to move it to the left, but you can move it to the. You can go closer for now. Yeah, there you go. Yeah, perfect. Yeah. You can just move it over just a little so we can see their name of the company, if that's possible.
Hold on.
Yeah, that's perfect. There you go.
Yeah, I want to make it so people viewing can see it a little better. I'm just going to try to zoom in just a little bit once again. Let me know. I'm covering the screen, so I can't say.
That's perfect. That's perfect. Perfect. Oh, you were just there. You were just there. Do that one more time.
Should have hooked up a mouse to this computer.
You just got to go. No. You just got to go a little bit to the left. That's it. So we can see the name of the company. Perfect. You're good. You're good. Right there.
Yeah, but you can't see everything though.
That's okay. This is good enough. You can move it to the left when you need to.
All right. So the white line is Apple. So that's the baseline. So you got your cash from operations, your CapEx, your free cash flow times the multiple of 18.37, which is rounded up from the actual number, total equity, free cash flow times the multiple plus total equity gives you this number. Got your market cap, and then you got your differential. And you got your baseline and your price to free cash flow. Out of the 38 companies, everything in red trades at a premium to this baseline. Anything in green trades at a discount. So, damn it.
That's okay. Just go a little bit. There you go. Yep.
So let's look at the first company under Apple, Alphabet.
Google. Yeah.
Better known as Google. Company generated $92 billion in cash, spent $30 billion on CapEx, $62.5 billion in free cash flow. All right, I'm not going to be able to keep it blown up. I'm sorry.
Just zoom in and then don't move it from there. That's it. Because that's all we need to see is the red and green, but it just needs to be closer. Just don't move it left and right. You can just read us the number. That's it.
All right. So right now, where the little hand is of course it just went away. Is Google.
First episode, guys. Have a little grace with us. So move it a little bit to the left, Steve, just so we could see the name of the ticker. The ticker matters more than the number, so people can see it.
All right. So I'll read off.
Perfect. Yes.
The numbers as I have it up on another screen. So Alphabet is trading at a 17.43% discount to my valuation methodology. And it's trading at 18.52x free cash flow. You look at Exxon. Exxon is trading at a 65% discount based off this valuation, and it trades at 7.51x free cash flow. You look at the car manufacturers. They trade single-digit price to free cash flows, and they're trading in a range except for Ford and GM. You look at Mercedes. Mercedes generates $13.59 billion in free cash flow. They are right here. This is free cash flow right here for Mercedes. More free cash flow than Tesla. and they're trading at a 78% discount on my valuation. Now, Tesla. Okay, so before I get into Tesla, Amazon, Shopify, and Intel, I have 0 here because in the trailing 12 months, they have generated negative free cash flow. So I left that number at 0. So just keep that in mind. That's why there's a 0 there. So Tesla's highlighted in yellow, and they are still at a market cap of $385 billion. And based on my methodology, they should be trading at around 204 billion, which is still 181 billion off of this valuation.
Yeah.
And I get it. It's a big differential, and people can make any justification. I'm not saying this is correct. I'm just saying that this is how I look at things. And we can come back to this slide, but the next one is very important. So you want to judge Tesla as a big tech company. You want to judge Tesla as if it's Apple, Alphabet, or Microsoft, because those are the biggest companies in the world. You're talking about, what has there been? Tesla was the 5th company to ever break $1 trillion. It was Apple, Microsoft, Alphabet, and Amazon, right?
Yep.
So Tesla's going to break $1 trillion market cap. It's being valued as big tech, in my opinion, but that would make sense. Would you agree?
Yep.
Okay. It doesn't have the margins of big tech. So you want to be valued as a big tech company? Well, let's talk about some margins. So right now, Tesla's free cash flow is 8.9 billion. Amazing, phenomenal, great company. Got to separate the company from the stock. And their net income is 11.19 billion. Phenomenal. This company's printing money. Phenomenal company. But they're operating at a 26.61% gross profit margin, an 11.9% free cash flow margin, and a 14.95% profit margin. Okay. Apple operating at over 40%, which is Buffett's golden number on gross profit, is 40%. And then free cash flow margin is 28%, and profit margin is just over 25%. Every dollar that Apple grows its revenue by, more than 25% is going to the bottom line. Alphabet, which some would argue is the greatest cash generating machine based on their business model, they're operating at a 56% gross profit margin, 22% free cash flow margin, and a 23.75% profit margin. And you look at Microsoft, the best margins out of all of them. Almost 70% gross profit margin, 31.19% free cash flow margin, and a 34.37% profit margin. So Microsoft generates almost $70 billion in net income, and Tesla has generated 11.19 billion in net income. Margins are nowhere near Microsoft's. If we go back to the other slide, Tesla is trading at 43.3x free cash flow. Microsoft is trading at 28.1x. Why should Tesla get a bigger multiple on its free cash flow than Microsoft?
Because it's growing 50% year over year.
But that methodology doesn't hold up. It's not just about revenue. Is Tesla a great company? Yes. Are they capturing the market? Yes. Are they growing at phenomenal growth rates? Yes. But the idea of business is to generate profits. And just because they have a great growth rate on revenue, which I think is 38% on the TTM, somewhere on there. I think it's just under 40%. 2021 was a huge number. I think they grew at like 78% revenue, which was phenomenal in 2021 compared to 2020. But it just, to me, it doesn't make sense. Maybe it makes sense to other people, and that's probably why the valuation got to where it was at one point. But when I look at these numbers and I look at, well, if somebody was going to buy the entire company, it just doesn't make sense paying that amount of a multiple versus these other big tech companies. So it's perplexing to me, to say the least, when I look at the margins. So, okay. So will Tesla reach ARK's expected case? It could, but I don't believe it's probable. Now, I did this highlight in yellow. This is the only number that is my number, is the 100 billion of free cash flow in 2026 for Tesla. The reason I did that is because ARK did not put it in the research piece. And if they did, I missed it and I apologize. But I took Tesla's current free cash flow margin and backdoored into what it would be if they did generate 843 billion in total revenue. So the price to free cash flow, if that happens, be 52.83. I mean, yeah, it could get to 5.3 trillion market cap on that valuation. We've seen Tesla trade over 100x free cash flow.
Right.
Okay, so could it happen? Absolutely, it could happen. Is it probable? I don't think Tesla's going to get to that revenue. So I don't really think that valuation is probable. That's my opinion. It could. I don't think it will, but it could. I mean, you're talking about Tesla growing by $4.9 trillion in market cap. Talking about their revenue growing by, what is that, $770 billion? I mean, it's so much. And they put these numbers out pre-split. So when you look at the split adjusted, current price for a Tesla share is $123.15. Telling me that Tesla is going to go up in their expected case by 12.5x over the next 4 years. When Elon Musk himself comes out 2 days ago on the All In podcast and says that he's expecting a recession that could last into, was it Q2 of 2024, he said?
Yeah. One thing is the margins. If the margins you're keeping the margins the same. Is that because you're trying to be conservative here?
It's because I don't know what the margins are going to become. So I have nothing else to base it on. Like I could rework the numbers and give them a little bit of latitude and say they improve their margins with economies of scale. But at the same time, we don't know what lithium prices are going to go to. We don't know what the raw cost to make the cars are going to go to. We don't know what the price per sale unit's going to be. So that's why I say you got to take everything with a grain of salt. This is just how I'm looking at it. And if I go by what Tesla has accomplished and what they're currently doing, it's hard for me to get to the multiple. Really is. And nobody wants to talk about the fact that shareholders get diluted left and right. So these are all split adjusted numbers. Once again, these are from Seeking Alpha. These are not my numbers. Over the past decade, Tesla has issued 1.44 billion shares. That is not from stock split. That is not from stock splits. That is just from issuing shares. Tesla shareholders have been diluted by over 83% over the past decade. So
is that reasonable? Do other big tech companies have that type of dilution?
Look, if you ask, I can't even say that if you ask a lot of people, because we don't have a lot of people to survey. If you ask me, I would rather see a company issue shares the way Tesla did than issue bonds or take on debt. Because if you, this was the smart thing to do. Because if you have investors that are going to buy the stock regardless, why would you take on debt? You issue more shares. You have a market for it. Right. It was brilliant. A lot of companies do it, and there's nothing wrong with it. But all I'm saying is, if you have 100 shares of a company, you own 10 of them. You own 10% of the company. If I go and issue another 100 shares and bring it to 200 shares, you now own 5% of the company. You are getting diluted. You're in for a fraction of the revenue, a fraction of the profits. From just a pure numbers standpoint, that's not great. And you look at what Apple's done, I should have got the numbers. It's right on Apple's website. I think they've given back 600 billion or 700 billion in the past decade since 2012. I hate giving bad numbers, so let's bring it up.
They apparently, Carl Icahn told them that if you do what we want you to do, you will be rewarded long term.
Can you see my screen?
No, you might have to share. Send me the link in the chat, the private chat.
You know what? I'll just tell you where to go. Just go to. Or I can hold on.
Or you just put it in the regular chat too. It doesn't matter. I'll pull it up. Let us know what you guys. Yeah, while you're getting that up, let us know what you guys are thinking in the comments. I know some of you are agreeing actually with a lot of the arguments Steve is saying. Some of you are disagreeing. A lot of the disagreements I'm getting, and I'm pulling up your number right now, is margins and growth is going to be better, which is an interesting argument.
Yeah, I get it. Tesla has phenomenal growth potential, but right now, you can't factor in what robotaxis are going to be. You don't know what the United States government is going to put out for laws for that. You have no idea what's the program's going to be. So you look at what Apple has done, and this is another reason why I say Apple is the greatest company in the market. Go to that right there. Capital returned over the past decade, $715 billion. So they have given shareholders through buybacks and dividends almost 2 Tesla companies. And this is a company that's buying back 20 billion plus per quarter of shares. So Tesla's out there diluting shareholders, which I'm not disagreeing with, but I can't get to these bull cases. I'm not saying Tesla won't go up. Look, I wouldn't short Tesla, and I think Tesla could go to $200 if the market rebounds in 2023 easily. Tesla's not a company you go short on, in my opinion. Too many people have lost their shirts doing it. It's worked recently, but for years and years, people got squeezed out of those positions. And Elon Musk is not somebody to bet against. You got to tip your cap to him. And I hate people complaining about Elon Musk this, and he's not paying attention to Tesla. Without Elon Musk, you wouldn't have got to this dance. You would have never got to those levels. He deserves all the credit in the world. And you can't just turn negative on him because he decided to spend some of his money and embark on a different project. If Tesla's numbers come out bad in Q4, and then Q1 and Q2, then you can start to ask questions. But he hasn't given anybody a reason to go negative on him leading the company as of yet, because there's no real numbers to base that case off of. So I think the guy's awesome.
Can I ask you some questions?
Of course.
Okay, Chat GP3, this thing just came out. You might have had a chance to play with it. The basic premise of it is that generative AI is going to be the next computing platform. It's here, whether we like it or not. It is going to be a thing. If Tesla has the best engineers in the world and the best people working on generative AI, just through all the data and all the talent that they have, is there, here's my first question. Is there not a qualitative argument to say you'd rather bet on Tesla than all of the other big tech that are growing at single digits, maybe low double digits year over year, and trust that team will do something with that AI? Maybe robotaxi, maybe Tesla bot, which is the big argument by bulls. Is that trustworthy for a company like that with that level of talent?
It's an unfair question. The reason it's an unfair question is because the company and the stock are two different things.
Yeah, so I'm asking a qualitative question that if the bot becomes a thing because they have this amazing AI, then the stock eventually reflects that.
Look, there is no doubt in my mind that Tesla can grow and that Tesla can generate 20, 30 billion a year in profit. No question in my mind that they can get there. This company's growth is not done. But if you think about what it's going to take for them to get to 30 or 40, let's say they get to 50 billion net income. Okay. They were at what, 11.9, roughly 5x. Let's say they get to 5x. Okay. Let's say they get to 60 billion, 5x net income, phenomenal growth. Are they worth $2 trillion? No. Just because they grew and they're generating that, Apple's a $2 trillion company right now, and they're generating $100 billion in net income.
Yeah.
So that's always been my gripe with these types of things. Growth is amazing. Growth should be part of it. But there is no perfect way to investing. And I hate that. Otherwise, investing would be simple. There's so many variables that you can't quantify, and I could be wrong. Tesla could become the most valuable company in the market in 6 years or 4 years. It could happen. But my question is, if a company is generating less profit, is it really worth as much as a company that's generating more profit? To me,
Yeah,
no.
and given the macro we're in, I mean, like, one could argue Tesla got to the $1 trillion valuation because no interest rates and a ton of stimulus. And like every company since then has fallen from grace. Tesla's been the last company to fall from grace. So could you make the case that in the next couple of years, as interest rates and inflation and all these other macroeconomic factors aren't as friendly as they've been for the past decade, that even if you're putting up phenomenal numbers, Apple, case in point, $100 billion in net income, the market's still not going to give you that premium simply because of the macro?
You can make a case for that. I mean, Apple's fallen what, 28%, 30% this year, something like that, and they just generated their best year ever.
Yeah.
So, yeah, it could. Look, we don't know what's going to happen. And it's just one of those things where I look at it from a numbers driven approach. And the bull cases that I have read, they don't really make sense to me because I don't see how they get there. Now, that could change. And keep in mind, my opinion can change every 3 months after the quarterly reports come out because I have new information. This is based on my information today. And if the information changes in 3 or 6 months from now, I could change my opinion. This is something that I look at all the time and it could change. But it's just one of those things where, sorry, but when you have
Okay.
Google, Microsoft creating those types of profits, and here's the other thing. You look at if Tesla disappeared tomorrow, is the world impacted? No, it's not. If Microsoft disappeared tomorrow, is the world impacted? Yes, it is. You're talking about how many companies run their businesses on Azure? How many companies use Microsoft Windows as their operating system? How many people use Microsoft Office? Can't replace those things. Not right away. You can go get a different car. You look at Alphabet. If Alphabet disappeared tomorrow, would that have a big, drastic ramification? Yeah, it would. I think 90% of search is through Google.
Let me ask a couple questions from the chat. J-Rob, here's an easy one. So as long-term investor, how is this relevant? How would you answer
As a
this?
long-term investor, you're probably up a ton. And look, as a long-term investor, that's your decision, what you want to do. I mean, I'm not saying that this is relevant to anything. It's just my numbers and how I look at things if I was going to invest today.
Yeah, and I think 4 to 5 years is relevant. It's relatively long. It's half of a decade, and you're looking at ARK's valuation in 4 years. I mean,
I'm not saying Tesla can't go up by any means. Just saying I think what people are looking at to do is not realistic.
Let's look at this comment. I wish you would conduct a more detailed analysis. For instance, Tesla just built 2 gigafactories in the past year that are impacting margins and cash flow negatively, but will flip positive. Too much nuance is missed with this napkin math. Do you think you have napkin math, Steve?
So if somebody wants to build an analysis and walk me through it, I'm happy to sit here and listen. Somebody wants to call this napkin math. That's their opinion and they're correct. Sure, napkin math. I would say that it's, not as in depth as it could be, but for the purposes of this conversation, it serves its purpose. Could I do an analysis that people wouldn't want to sit through? We could do if you give me a week, we could do a 3 or 4 hour podcast and I can go through all the numbers and people go to sleep. So it's all how you look at things.
Yeah, and I mean, at the end of the day, most investors, especially in retail, are not doing, forget napkin math. They're not doing basic right on your fingers math, right? They're investing off of the feeling. So let me ask you a question about this. Do you think the cult of Elon, which has undoubtedly carried the stock, will continue to carry the stock if they miss numbers and if Twitter still becomes an overhang? Do you think that gets him through the next couple of years? Is the cult strong enough? Is retail strong enough to deal with seeing Tesla go to $80 a share if that happens?
Well, look, I've said it probably 3 or 4 times already. I think it's unfair for people to judge Tesla off of what he's doing with Twitter. I mean, the guy decided to spend some of his money and buy another company. That doesn't mean Tesla's going to do bad. So I dislike that is occurring, and that mentality is out there with some people. It rubs me the wrong way. But I mean, look, Tesla can go up. I'm not saying it can't. It can go up. And if the markets rally, people are going to look at this stock and they're going to see that it used to be at X. And man, I can make a profit. And I think retail could drive this thing back up if we catch a bull market. Or even if we don't catch a bull market, we just catch 10 or 15% wave up, I would think that Tesla would go up. I wouldn't bet against Tesla. I cannot say that enough times. I wouldn't bet against them. I just think that they trade at a valuation that's rich because I can't quantify the other things that they may or may not do. I mean, can't invest on things that aren't a reality yet. Got to have some premise around it. The U.S. government could come out and say no, or they could put such crazy restrictions on it. We just don't have the data. Give me some data and I'll work it into the analysis.
What is your fair value of Tesla stock?
So if I based it strictly off of Apple, my fair value would be 204 billion market cap. But you want to
So you go from 395 to 204.
But given the growth rate,
that's another 50% decline, basically.
Given the growth rate and the foothold they have on EVs and a declining price, I don't think it's crazy to give them a premium 250, 275 billion market cap. And Coca-Cola trades at a 32% premium from where Apple does, based on my valuation methodology. So if Coca-Cola is trading at that, Tesla should trade above that. I'm not disputing that. I think a lot of companies are valued incorrectly. But at the end of the day, Tanner, I said that just because of you, I think Tesla could come down, but if they have good Q1 numbers, I wouldn't be surprised if they go up significantly.
Let me ask you a question. You've been investing since before 2010, I would argue, correct? Mm-hmm. Why didn't you buy Tesla stock in 2010 till 2017? And if you did buy it, would you have sold way before at 10,000x?
So I didn't invest in it because I can't own every stock. And I thought that my money would be better in other areas. I've always thought Tesla's valuation was rich, and I'm not a day trader. If I was a day trader and if I was a short-term trader, I probably would have hit it for some of the rallies, but I'm not, and I didn't. And look, Tesla's made a lot of people a lot of money. It's been a great stock for a lot of people. I'm not discounting that. I wish I invested. Yeah. Tesla, until recently, has proved me wrong. But I've been more right in the past 8 months than I have been wrong on Tesla. But if that holds is another story. We don't know. Tesla could go up again and I could look like a crazy person.
So when it was valued at $1 trillion, did you want to punch a wall or something?
No, I just
not because you were angry, but just because you couldn't believe the market was giving that type of valuation to a company.
Yeah, I mean, look, I made money on other companies during those crazy valuations. I didn't make money on Tesla, but there was a lot of things that were overvalued. And I know people are going to say, well, you're bullish on Palantir. Yeah, I've lost money on Palantir. I'm not selling, I mean, I think Palantir is going to be a great investment. But I've always said, I'm looking at it from 2030 and I'm buying it now because I could be wrong, but I'm going to keep buying, dollar cost average because I don't know when it's going to go up. I don't know. I don't have a crystal ball. If I had a crystal ball, it'd be a lot easier. Investing is not easy. Tesla's been a great company. And obviously, a lot of people have made a lot of money on it. People love the stock. I wouldn't be surprised if it catches a bid if the market starts to turn.
So let's end it on this question. Let's say Tesla goes from 300 to 1 trillion within the next 2 years. What do they have to do outside of the car sales, unless they just explode that, right? But let's assume they don't explode that.
They
What
don't
do
need
they
to do anything outside of the car sales. They could get back to $1 trillion. They got to $1 trillion with just car sales already.
Yeah,
Why
but
can't they do it again?
well, you could argue that low interest rates, just like, you know, like that wasn't purely based off car sales, right?
Yeah, but if they continue to bring the price of cars down, semi comes out, and if that gets a lot of traction, they could go back to $1 trillion. Why can't they?
Okay, so you're not even worried about the bot or the robo taxis or Tesla Energy, right? You're not worried about any of that stuff.
I
You just want
mean,
the
look,
cars.
Tesla Energy, I think Q3 was the first quarter that it actually delivered positive gross profit. I mean, that has been a losing business when you do energy and whatever the other component is. I forget how they break it up. I don't have, actually, I do have the slide somewhere. Hold on. Tesla breaks it up as energy generation and storage, and then services and other. So when you combine those two segments, I think Q3 is the first quarter ended up positive on a gross profit level. Every other quarter, it's been negative when you combine those two. So it's great for revenue, but if it's not generating profits, I mean, it's not really working into the way I look at things. But Tesla is one of those companies, and we say it all the time with Palantir. Why are so many people so bullish on Palantir? Because it builds systems that can be cross-sold through other value chains like Skywise and Hyundai Heavy and all these other companies. It's not just their operating system. They partner, they build proprietary systems that other companies can go out and sell and they'll collect revenue from. We don't know. Tesla could become the biggest company in the world based on all the things that may happen. Robots could be huge. I mean, there is such an application for exoskeletons, for the robotics application in warehouses to.
But my question, are you bullish on that? I know you're saying it could be huge, but gut feeling, do you think that's a thing? Or
I mean, look, as a species, we don't stop evolving. At some point, AI is going to be like a real thing. Robotics is going to be a real thing. And there are a lot of things. You look at how much we have advanced in the past 5 years, past 10 years, past 15 years. We're going to keep advancing. And these are probably going to be, if you really had to think about it, AI, robotics, those are going to be the next innovations of growth. Tesla is primed to catch some of that. But until we start seeing numbers about how they do it or what the game plan is, it's very hard for me to figure that in because there's no way for me, at least, to figure out any type of growth projection on a revenue base and work it backwards into net income and free cash flow. So no, I'm not.
You should get that on a shirt.
Look, and look, insurance, if they were to open it up outside of Tesla, could be huge. I don't know if they're going to or if they do, but I mean, I'm not bearish on the company. I just think the valuation's a little rich. What about you? What do you think?
I agree with everything you said. I mean, I'm bullish on the company, obviously, like you. I own some individual shares. I want to increase the Tesla position, but numbers is a bigger thing I've been getting into a lot more because I think I started off naive like every investor in 2019, which is just like based off hype. And I don't blame myself. I was like 20 years old, but now I'm getting more deeper into like, what is free cash flow? What is price to free cash flow? Why does it matter? What is a PEG ratio, right? Like actually going deep into these things. And I still come out on the other side being more bullish than not on Tesla because I don't want to bet against Elon. And I don't want to bet, as you said, about where the world's going and which companies I think can capitalize. Like, I think Microsoft will capitalize on AI. I don't know if Google's going to capitalize on AI as much as Microsoft. You know, like maybe they will, maybe they won't. I think Meta is going to capitalize off AI because if AI really becomes a thing, the metaverse has an even better chance of becoming a thing. I don't know if Apple will capitalize on AI as because Apple is a hardware business at the end of the day. Their services are, I know it's growing, but it's mainly hardware. Like, is there going to be an iPhone 30? I don't know. So like the trend the world is going to reflects the company I want to bet on. The question becomes, is the valuation at this moment the bet you want to make, even if you think the company is in the right place of the trend? And for Palantir, I think it's match made in heaven for me in terms of where the world's going and the valuation now at this level. For Tesla, is still up in the air.
Yeah, I mean, you put it really well. And I wouldn't be shocked if Tesla becomes a 300 or 400 billion revenue company. I really
Yeah.
wouldn't be. They have so much potential ahead of them. Elon's a visionary. I would not bet against him. Microsoft and Alphabet and Meta should all theoretically do well with what's coming down the pipe with technology. Which one's going to do the best? I don't know. I'm not a shareholder in Microsoft directly. I am of Alphabet and Meta. They're both, to me, significantly undervalued. I think Meta, it's going to come down to these Q1 and what Zuckerberg comes out and says. I mean, I am big on the metaverse because it's not just about video games. There's a lot of applications out there for it. You think about training for aviation, other types of professions,
A
learning.
lot of stuff. Yep.
There's so many things it can be. It's just got to be done right. And look, Meta is so far ahead of the game. If it's going to happen, I don't see anybody beating them in that area. But
so let's do this. Leave it in the comments below. Thank you guys so much for being here. We had 150 people here consistently. Steve was a little worried how people would react to it, but I think the most of the responses we got were pretty positive in terms of people just accepting the analysis, liking the analysis, and if they disagree, then respectfully disagreeing. Should the next episode be Palantir or Meta? Should the next episode be Palantir?
Let's do Meta. I mean, you do Palantir so much. I mean,
yeah,
Palantir is
probably like
Palantir, but I mean, the information is out there every week on it.
Yeah. So leave in the comments what company you want us to do next. So that's the nature of this podcast. 1 hour. We did 1 hour and 11 minutes. I hope you guys found it valuable. We dived deep into the numbers. We pretty much only talked about numbers, but there was a mix of outside analysis that hopefully influences some of the numerical analysis. And that's it. Every week, one episode, one company. We dive deep into it. The conclusion is it undervalued or overvalued at this valuation? Steve, you would still say Tesla is a bit overvalued, correct?
I would not bet against Elon. I would not bet against Tesla. I am not short. Technically, I'm a shareholder because my wife bought shares. She's a much better investor than I am. I will say that every day of the week. Whatever she buys seems to go up.
Wait, did she just buy it just for fun? She was just like, I like Tesla. I just want to buy it.
No comment. She is amazing with investing. So I don't know if she's watching or not, but I will tell you a story that when the financial crisis was occurring and all the companies were getting bailed out and everything, and Ford was at like $1.80 or $2.10, she was like, we should buy a lot of it. I'm like, oh, I don't know, blah, blah, blah. And she bought it. She did very well on it. She is very good. And it is not what she does for a profession. She's very good at it.
Okay. I love it. All right. It looks like Meta's next. That's what people want. Meta, Uber, Cloudflare. We have some good comments. Cloudflare is interesting. Meta, it seems like we'll do Meta and then Amazon and then Uber and Cloudflare. It seems like those are the next four in a row.
People may not like what I have to say about Amazon, and I'm a shareholder.
Okay. That'll be it. Thank you so much, everybody, for joining. Check out Steve's Twitter in the description. From his Twitter, you'll get to his Seeking Alpha. Really appreciate you guys being here. We'll start a separate channel for like clips of this podcast soon, hopefully in the next couple of weeks, and keep it going from there. Thank you, everybody. This was a great first episode. Really appreciate you guys coming out. We'll see you next week. Bye.